The biggest bottleneck we all have for starting or scaling a property investing business is access to capital. Because you probably realize that just relying on your own money, your own savings, it's going to take you a very long time to do the amount of deals you want to do, the size of the deals you want to do to ultimately achieve your goals. Therefore, we need to learn the skill, the most valuable skill in property investing, which is how do we raise private finance? Essentially, how do we find private investors? And then how do we progress those conversations with these private investors and essentially get them to agree to partner with us or to help fund our deals? And if you can learn this skill, this is what's going to take you from doing maybe one deal, two deals over a number of years to building a property investing business, doing multiple deals, doing bigger deals. And in this video, I'm going to share with you exactly what that process looks like, exactly how and where do we find these private investors? What is the initial conversation we need to have with them to get them engaged? And then how do we progress those conversations? Essentially, how do we sell to them? How do we sell ourselves? How do we sell the opportunity? How do we sell the deal to the investors? And then how do we structure the deal with the investors? What are the legal agreements you need in place? What is the structure of the money within the deal and how the money is utilized to actually fund the deal? Now, in case we haven't met yet, my name is Tyler Newman. I've raised multiple seven figures from private investors for my property investing and developing business. I also have a high-end estate agency business where we specialize in the marketing sale of luxury homes. And we've also helped countless other people raise their first private finance from private investors. And over the years doing this, I figured out a very simple, proven process that I'm going to explain to you here today. So the first thing you need to figure out is how do we actually structure the money within a deal? The mistake I see a lot of people make when they first come to me and they ask me or my team, hey Tyler, how do I find these investors? How do I raise private finance? They're so infatuated with the actual process of finding investors, where to find them, how to have the conversations with them. But I quickly realized they're lacking the knowledge in the different creative financing structures, the different ways you can structure the financing in a deal using private investor finance, using commercial finance. And when I say commercial finance, I'm referring to banks that are there to lend money in the form of bridging loans, in the form of buy-to-let mortgages, refurbishment loans, development finance, etc. And when I realized that actually those that are asking me, how do I find investors? They don't have this level of knowledge. What I found is when they learn that knowledge, when you understand, okay, what are the different ways I can structure the money within a deal, it gives you, the property investor, the property entrepreneur, the confidence to actually have more meaningful conversations with an investor, because you can better educate them, you can better present to them the different options. And it gives the investor more confidence as well, especially the more sophisticated private investors that have made a lot of money in business, or maybe they've funded other property investors like yourself before. If you can speak their language, if you can demonstrate you have a deep understanding of the different financing structures, what the different pros and cons are of each, what the different risk factors are with each method of funding, again, they're going to have more confidence, and the likelihood of them wanting to do business with you, them trusting you, is going to be significantly higher. So before we talk about the different ways you can find investors and the sales process of progressing those conversations with investors so they can actually then ultimately commit to funding your deals, I want to run through some of the different creative financing structures. And I don't really like the term creative financing. Really, it's just capital structures. What are the different ways you can structure the capital or the money within a deal? And this is a whole 5, 6, 7, 8 hour topic. I've spent days coaching this to other friends and people we've worked with before. And it's a very complex topic. And really it was this level of knowledge, this understanding that helped me take things to the next level, helped me raise more finance, bigger finance from more sophisticated investors. And actually I had a friend that I met in the gym once about 3 or 4 years ago, maybe a little bit longer actually. And he approached me in the gym. He said he recognized me from social media, and he introduced himself, and he told me that he was working in private equity real estate. Now, if you don't know, private equity real estate is basically where there's a fund, they have a big fund of money from various different sources, and their job is to go deploy that money into big deals. And this particular friend, this individual, he was working on the acquisitions team of a private equity fund that was managing about 4 billion euros. And we connected, we went for a coffee, we got to know each other a little bit, and he kind of pulled back the curtain on their business, how they look about deals, how they think about deals, how essentially they allocate capital. Because the biggest and the best property investors, property developers, they are finance businesses, they are capital allocators. They are in the business of raising finance from investors, and that could be from pension funds, it could be from high net worths, it could be from family offices, it could be whatever. And then they go and deploy that money into deals and generate a return, and then basically take a share of the profits with their investors. But when you're deploying 4 billion euros into deals, and then you layer some debt on top of that, you can be buying maybe close to 10 billion euros worth of deals. You don't need to be making huge profits for obviously your sliver, your profit share as the fund owner to be a meaningful amount of money. But anyway, I digress. The revelation that I had from having these conversations with my friend that worked in private equity real estate, that ultimately real estate is a finance business, and the level of sophistication they had in terms of their knowledge of financing and different structures was really a bit of an eye-opener to me that, okay, cool, if I can implement some of this into my own business, I can start thinking and operating like a sophisticated capital allocator. This is how I take things to the next level. And my friend and his team of associates that worked in this private equity real estate fund, and the same for a lot of these funds, they didn't go through what I call like the grassroots level of property investing, where they buy their first property for 100,000, put a new kitchen in, new bathroom, plaster the walls and carpets. Instead, they go and study finance. They go get a master's in finance at university. And it's this knowledge, this skill set that allows them to go and literally raise billions or hundreds of millions of euros, of dollars, or pounds to then go and do these huge real estate deals. And that was a penny drop moment for me. It was like, okay, cool, I really want to deepen my understanding of this. Now, before we get into the specific different types of capital structures and the way you can fund deals with investors' money, the first thing you need to understand, which acts as the foundations of all of this knowledge, is understanding the capital stack. Now, the capital stack is something that's typically expressed as a diagram, and it's a diagram that showcases the different layers of capital that make up the ownership or the acquisition of a deal. This could be a business, but in this context, it's a property. Now, a simple kind of example of this is if you're going to go buy a £100,000 property and you're putting down a 25% deposit and a 75% mortgage, well, that capital stack, you're going to see on the diagram, there's £75,000 worth of debt and there's £25,000 worth of equity. Now, the capital stack is layered in a particular way to demonstrate who has priority, which of the stakeholders, i.e. the sources of capital, have priority in what we call a liquidity event. And a liquidity event in property is primarily going to be a sale or a refinance. It's essentially when there's new money coming into the deal. So if you ever sold a property before, the buyer of the property you're selling to, they're going to be sending their money to their solicitor, which gets sent to your solicitor. And if you had a mortgage on the property you were selling, well, the solicitor doesn't just pay you the full sale price, the full 100 grand you sold the property for, and says, oh, Tyler, by the way, can you just pay off your mortgage? No. The capital stack in that scenario, it's we call the senior debt, the first charge lender, i.e. who's got the mortgage, is going to have the priority in payout. And therefore, when you're selling a property, your solicitor pays off the mortgage first, and then they send you the proceeds. That's because the first charge lender, the mortgage lender, or the senior debt is another term used to describe them, they have priority in payout. And there are many different ways the capital stack can be structured. It can get a little bit more advanced. You can have more than 2 layers of capital making up a deal. You can have 3, 4, even more stakeholders essentially providing funding to a project. Now, again, this will take me hours to explain in full, but the key thing you need to understand with a capital stack is that it also demonstrates who's taking the most risk in a project, and therefore who should be rewarded the most return on investment, the most reward. And so someone that has the first charge, they are the most senior in the deal, they have the priority in payout upon a liquidity event like a sale or a refinance. They are generally going to be lower risk because they're going to get paid back first, even if the deal doesn't perform as well. So if you're buying a property you're adding value to, and maybe the end value you're projecting, you don't quite hit that, you end up selling for a little bit less, or there's some delays and your construction costs increase and the delays lead to maybe your interest payments increasing a little bit. Well, whoever's got that first charge in a sale or refinance, they're getting the money back first. And so if there has been profits that have been wiped out, well, then it's you as the equity that's likely going to get hurt first. And so when you're the equity in a deal, you're the deposit, it's essentially the risk money. And equity, they get hurt first, but they also get the most of the upside. And so again, if the deal goes the wrong way, well then the equity is going to get hurt first, and the first charge lender in kind of the simple example I've shared with you, they're still going to get hopefully all of their money back. So they're slightly lower risk. But the equity, if the deal goes well and you sell it for more than you expected, maybe you find savings in the construction, your profit margin increases, well then the first charge lender, they still only get back the money that were owed. They're not necessarily going to get the upside, the increase in profit. That's for you. So it's important to understand the equity going into the deal, they're taking on the most risk. Now, depending on where someone sits at in the capital stack, like I say, determines their risk, but you need to then understand the difference between, or the relationship between risk and reward. Because those stakeholders, whether it's a lender or whether it's an investor that's bringing equity, and we'll talk about kind of joint ventures and how investors can bring equity and the difference between equity and debt, these stakeholders, the stakeholders that are taking on the least risk will also be getting the least reward. And this is where, like I say, you need to understand the relationship between risk and reward, because I could say to you that I have a way that I could potentially double your money in the next 24 hours. But that might sound like a good deal. That might sound like a good return on investment. But if I told you my strategy to do that is I was going to go to the casino, take your money, put it all on red on the roulette table, and hopefully double your money, well, then you would quickly realize actually that risk to reward ratio isn't really a good opportunity, because as we know, the house always wins and the risk to reward isn't there, which really answers the question that I get a lot, is like, what do I offer to an investor in return? Well, the answer is it depends on their level of risk. And so by having this understanding of the capital stack allows you to understand, okay, cool, where is the investor going to sit? Are they going to be a lender on first charge? Are they going to be providing equity to the deal? Are they going to be a second charge? All of these different methods I'm going to be sharing with you in a second. And then depending on their level of risk will then determine their level of reward. Because figuring out what return to offer or pay an investor is simply an exercise of just pricing the risk and figuring out what is the risk. And therefore, for the investor, they've got to make a decision. Am I getting a reward, i.e. a return on investment that makes sense for the level of risk that I'm taking? Now, there's other things to take into account when understanding what return to offer an investor. There's an element where it depends a little bit on the markets. And we have something in economics called the risk-free rate, which basically is government bonds, and depending on what government bonds are paying determines what investors can get by just putting money in government bonds. And if they can get 5% in government bonds, they might not be interested in getting 8% from you, because that extra 3% ROI for what looks like a much more bigger level of risk might not be worth it. Whereas if government bonds are paying out 0%, well, then suddenly investors might be happy with 6, 7, 8% on their money investing in something like you, because they're getting 8% more or 7% more than what they're getting with government bonds, and they're happy to take on that extra layer of risk to get the return. So that's how you price returns. That's how you figure out what can I return to an investor. And that understanding of the capital stack acts as the foundations for the different ways of funding deals with investors I'm going to talk to you about. And so there's a handful of ways you can fund deals with investors, and I wish I had hours and hours to share them all with you now, but the first and most commonly understood method of funding deals with investors is what we call a joint venture. And so it's important to understand that when you're funding property deals, rarely is access to debt the problem. What I mean by that is there is countless commercial banks, these banks that are set up with balance sheets and books with hundreds of millions, that are in the business of lending money to people like you and I for our property deals. That's how they make money. And so there is no shortage of capital from these banks. But the thing you need to understand is that these banks with bridging finance, mortgages, short-term lending, long-term lending is, yes, they'll fund a majority of the cost. They could give you 60, 70, maybe even close to 80% of the total cost of a project in some instances, but rarely are they going to fund the entire deal, the entire capital stack, the entire cost stack. And so in their eyes, if there is enough equity going into a deal, if the investor is willing to put basically a deposit, the risk money, the money that's at risk, well, they're happy to leverage that money with bridging finance, mortgages, etc. And so if we think of a typical bridging lender, they'll be giving you 75% of the purchase price. That might net down to 65% after fees, after retained interest, which we'll discuss in a separate video. But that basically means for every £1 going into a deal, the bank is willing to give you £2. And so £50,000 of cash gives you £150,000 approximately of purchasing power. And really, even if you're a first-time investor, there's a level of flexibility with bridging finance where as long as you have a good team, you have a deal that makes sense, and a good finance broker, often they can position you properly where a bridging lender is going to feel comfortable lending you money. Now, the terms might not be super favorable if you're a little bit inexperienced, but they're still going to work. Bridging finance is really not as scary as many people make it out to be. Again, that's a separate video. But what I mean by this is the benefit of joint ventures is a joint venture is where a joint venture partner is bringing equity to a deal. So like a first principles approach to joint ventures is where two or more parties are coming together to achieve a common goal. Now in the context of property, that could be you as the operator, the property entrepreneur, is responsible for finding the deal. You are responsible for assembling the team that's going to be helping deliver the deal. You're going to be the one delivering the deal and kind of managing the exit of the deal, essentially doing a lot of the hard work. And then your joint venture partner, your funding partner, your private investor is going to be providing the funding for the project. And the most common way this is structured is they are going to be bringing you the deposit that's required, and there's going to be a profit share. And this investor is taking on the risk of the deal with you. Now, they're not necessarily going to have security in the form of a first charge or a second charge, because the first charge is going to go to the bridging lender. but they are going to have a shareholding in the project. And so when you go to do a joint venture, you're going to set up a SPV, which stands for Special Purpose Vehicle, which is just a limited company that you set up for the special purpose of doing this particular project. And there's a number of reasons you do it in SPV. One, to kind of contain the risk within this project, within this company. So if that deal does go wrong, it's not going to affect other properties, other deals you have going on. But also for the joint venture partner, then they're coming in as a shareholder in that company. So their security, if you like, it's not really security as in they've got a charge against the asset, but their security is they own a share of the company, they own a piece of the company. They own equity in the company, they're bringing equity into a deal. And so if you've ever studied the financial markets, you might have heard of the equities market. And the equities market is just the stocks and shares, the share market. And when you go and buy shares in Apple or Microsoft or Google in the stock market, in the equities market, your money isn't secured. You're not loaning money to Microsoft, to Apple. You are making a bet that the future value of that company or the future value of the shares is going to be more than what it is now. It's essentially buying shares. And that's what a joint venture partner is doing. They're buying shares in this new company that you've set up, where the business plan for this company is to deliver this project, where by the end of the project, the value of the company is going to be higher because you've made a profit. And at that point, there's going to be some kind of profit share. There's a certain legal agreement you need, a joint venture agreement or a shareholders agreement. There's a few other things to bear in mind in terms of the long-term goals of the investor. You have some investors that want to co-own the asset with you long-term, where you do the property up, you add the value, you go to refinance it, you keep it, it produces a rental income, which is then distributed in line with the profit share agreement. But you might have some investors where they're happy to do a joint venture, but they want to get in, add the value, and then they want to exit their position. They want to cash out at the end of the deal. Whereas if your goal is to own the property long term and do a buy, refurbish, refinance, where you are then benefiting from the cash flow, from the capital appreciation over the long term, well, then there's going to be something you need to plan for, which is how do we buy out the investor's position at the end? And this is where you have to start thinking like a financial engineer. And this is where when you understand the different creative financing structure, the different ways to structure the money, you think like a CFO of your property business. You have multiple deals on the go. You can start to plan for these things. So an example of that is you could raise a little money from a loan to buy out the investor's position. You could maybe have another property you've got doing in tandem, which is going to be a flip. You're going to realize the profits from that flip, and you're going to use some of the proceeds, some of the profits from that to buy out the remaining piece of the investor, because the refinance distribution on the joint venture you were doing wasn't enough to pay the investor back in full, their principal plus their profit share. Now, if that's too confusing, don't worry. A lot of people don't take this all in first time around, but that's joint ventures in a nutshell. The other ways investors can come and fund projects is through loaning money. They can be a lender. Now, they could be a first charge lender where they're providing what's called the senior debt, i.e. essentially acting as a private mortgage or a private bridging loan. There's some benefits to this. One, the investor has more security, so they're typically happier lending larger sums of money. Can be more flexible. You can beat the rates that the banks are offering. So maybe the private lender, the private investor is willing to take a lower interest rate than what you would get with bridging finance. Maybe bridging finance, you're getting offers of 10%, 12% a year, and the private investor is happy with 8% a year if it's secured with a first charge. Now, the downside is they might still not be prepared to fund 100% of the purchase price. Sometimes they might. Some investors are a little bit lenient, but for the most part, there might still have to be an equity requirement. There's also the opportunity for investors to come in on a second charge. So you could have the bridging lender from a commercial bank come in and do the first charge and provide you 65% of the costs, but there's still 35% of the cost you need to find. That could come from an investor that sits as a second charge. Now, benefits of this is that you can still offer the investor security, but the other thing to consider is that you are essentially 100% leveraged, which might be fine on some opportunities where you have high conviction in the deal. Maybe you're buying at a discount where on day one of completion, there's instant equity. So you're not really going to be falling into negative equity at any point. The other thing to bear in mind is probably not worth doing that on all your deals. So for me, some of the most sophisticated property entrepreneurs I know is they never want to be on their balance sheet, have too much debt where they're too over leveraged. And so they have some joint ventures where the investors are coming in on an equity basis, and then they've got a couple deals that they have more high conviction in that they bring an investor on as a second charge. The benefit of a second charge investor, for example, is the cost of capital is still going to be less for the most part than what it would be for a joint venture partner. Because a joint venture partner, you're giving away 50% of your profits. The ROI, return on investment you're offering to the investor could be 25, 30, 35% or even more. Whereas a second charge investor, second charge lender is you could be offering them 12% a year, 14, 15, 16% a year, maybe up to 18% a year if you really want to be bullish. And like I say, you've got good profit margin in the deal. The other downside of raising private finance as debt, whether it's first charge, second charge, is there's going to be interest payments. And if there's any delays with a project, well, those interest payments rack up and rack up and rack up. So if you find yourself sitting on a property where you're waiting for planning permission, or you're stuck waiting for council sign off with building regulations certificate or something, well then every week, every day, every month that goes by, you're going to be racking up interest. Where if it's a joint venture, yes, you might have the first charge lender where you're racking interest, but the equity investor that's come in to provide the equity, well, they're not going to be penalizing you for and charging you interest. Now, they might be a little bit frustrated that there's going to be delays, but ultimately that's the risk they're taking on. They're making a bet on the business based on the facts and the figures and the business plan of the deal you present to them. So we talked about first charge loans, second charge loans. Another one is raising money that's unsecured, as in it's not secured against the property with a first charge, with a second charge, and it's used as what we call working capital. And there's going to be a loan agreement where you're going to sign it with a private investor who's going to be loaning you money. And the money can be used as deposits in property, to go and buy property as working capital, which is a term you might have heard in accounting or general kind of business purposes. And there's a couple kind of instances that you would want to utilize this. So first of all, let's say you're meeting with an investor and they have £50,000 they're willing to play with. But you know, with the deals that you're looking at, the deals you want to do, that £50,000 isn't going to be enough for maybe a joint venture or even for a second charge, because it's not enough to fill up the amount of money that you need. If you're going to need minimum £150,000 to put into a deal, well, this private investor, they might be willing to put £50,000 to work with you, but you know that's not going to be enough. And so one opportunity is that is going to be an unsecured loan, which you use as working capital. Maybe you have a couple of investors that both bring 50,000, or one brings 50,000, one brings 75,000 pounds. And you can put that in as the deposit money into a property. It could also be used to buy out the position of a joint venture partner when you're exiting a deal that the investor wants to cash out, you want to keep the property long time. It could be used for the refurbishment money. Maybe you have someone that's willing to fund the purchase of the property, but there's still 30 or 40, 50,000 pounds needed for the refurb. That's what the working capital can be used for. It could also be used for what we call the soft costs of a property acquisition. And the soft costs are essentially all of the costs where you're not paying for something which adds tangible value to a property. So it's not really funding like refurbishment works. It's not really funding the acquisition of a property, but it's funding things like surveys, like architect's drawings, like planning applications, other reports you might need from various other kind of professional teams to support the planning application, which when you're doing multiple deals can add up. It could be 5 grand, 50 grand. I've got some friends that have got 500 grand's worth of soft costs that they have to pay for the size of the deals that they're doing before they even complete on an acquisition. And so maybe you're going to do an acquisition for a HMO conversion and you know there's going to be about 5 grand needed. Or maybe you're going to do an exchange with a delayed completion where you exchange contracts on £15,000 or £20,000, and there's another 4 or 5 grand needed for architect's drawings, for a measured building survey, for whatever else. Well, you can go raise that £20,000 as working capital from a private investor that's loaning you the money. And then you exchange contracts, you have that period where you take it through planning permission. Once planning permission is achieved, you have a joint venture partner that comes in, they provide the equity, and then you pay yourself back the money that's been spent so far, so you can then return that to your private lender, or you can go use that money again. And typically these loans are structured as it could be 6 months, it could be 12 months, it could be 18 months, they could be even longer. And there's a loan agreement where it explains what's the principal amount that's being lent, what is the interest, could be 6%, 8%, 10%, could be more, could be less. And sometimes these loans can be secured with a personal guarantee as well. So if you don't know what a personal guarantee is, it's something that at some point in your property journey, you're probably going to need to sign, especially if you're going to be utilizing commercial finance with bridging loans and maybe in some instances with mortgages. But a personal guarantee basically states that you are personally guaranteeing the repayment of that loan, even if the company you've set up can't afford to repay it. Because as you know, with a limited company, the word limited refers to limited liability. And so typically any debts, anything going on with the finances of a limited company, if that company falls into a bad place, you can really just dissolve the company. Now there's a process behind that, but personally, you're protected. But by signing a personal guarantee, you're actually kind of putting some more skin in the game and saying, well, hey, look, I know you're loaning money to the company. You're loaning me 50,000 as working capital. And we'll get to this, but when you're raising this money, there's a right way to position these things and a wrong way to position these things with an investor. But you might offer to sign a personal guarantee, which says, look, even if the deal doesn't work out, even if the performance of the company doesn't go to plan, I will still personally guarantee the repayment of the loan. And so that's one way you can raise money as well. So that's kind of a whistle-stop tour of some of the different ways you can structure deals with investors. I could go down multiple rabbit holes with each one, but if this is something that you found valuable so far, you want to learn this process in more detail, want help raising finance from private investors, I'm going to link another YouTube video, which will be the first link in the description of this, which I highly recommend you watch, where I break down exactly how we can help you raise the finance you need in the next 90 days for your first or your next property deal. So let's move the conversation on to how do we actually raise the finance from private investors? Because now we've got a good understanding of the different finance structures. How do we actually go find these investors? Now, there's some mindset shifts that need to take place, but the primary mindset shifts are two things. One, these investors are everywhere. And we get so used to calling these investors private investors that we sometimes think they're these elusive, behind closed doors aristocrats that are hard to get in contact with. But that couldn't be further from the truth. In fact, most people are pleasantly surprised with how many people around them actually have some money lying around, or at least connected to other people that have money lying around. And so the first thing you need to understand is that investors are everywhere. And the second thing you need to understand that is money is very, very, very abundant. Now, I don't know the situation of everyone listening to this video, but maybe you're listening to this where you actually feel in your environment, money is very scarce. No one really has much money. Everyone is kind of broke. And that might be true for the bubble that you've created for yourself, that you found yourself in. But I promise you, if you walk through Mayfair on any night of the week, but a Friday night, a Saturday night, you will quickly realize there is a lot of money in circulation. And I heard a quote recently, is that when you're broke, it seems like everybody's broke. And when you're rich, it seems like everybody's rich. And that's just because you exist in different bubbles, you exist in different environments. And so get it into your head, understand that capital is the most abundant resource on earth. So how do we actually find these investors? Well, there's a 4-step process that I like to walk people through, but if they follow this process, they should hopefully connect with some investors. And this is a proven process. I know this process works, not just because it's the process that's helped me raise millions and millions of pounds for the deals that I'm doing, that I've done, but we've helped many people raise finance as well. People like my friend Jamie, he raised £453,000 following this process, which he used to go fund the purchase of 3 HMO deals. One of our clients, Dean, he raised £300,000 in the first 30 days following this process, which he's now using to go and start his property investing business. And so if you want to find out more what this 4-step process is, again, the first link in the description, there's a YouTube video where I break it down in a little bit more detail. But the first step in this process is looking at your personal and professional network. These are people that you know on a first name basis. I call it the low hanging fruit. And the reason it's the low hanging fruit is because there's an element of trust that's already built with people that know you and you know them on a first name basis. Because ultimately, when we're building connections with investors, what we're optimizing for is getting people to know, like, and trust us. That's what building relationships is. And so when you get serious about scaling your property investing business and want to embark on the journey of raising private finance, there's almost this identity shift that needs to take place. That I am now someone that is rewarded for making connections and building relationships with people. You then start to see events and getting in the right rooms as an opportunity, and paying to get in the right rooms, and almost paying for relationships as a return on investment. And so with your personal professional network, hopefully a lot of these people that you know on a first name basis that are 1 or 2 degrees of separation away from you should already know, like, and trust you, because the people that you know, they know, like, and trust you. And then the people that you know, the people that they know, well, if there's a warm introduction, if they trust their friend that's introducing you, again, there's kind of a transfer of trust that happens there. It's why it's called a warm introduction. And so the first thing I always encourage anyone to do is you want to tap into our personal professional network. And with this, we are reaching out to them through whatever means necessary, like whatever channel makes sense, communication channel makes sense for that particular relationship. It could be WhatsApp, it could be a Facebook message, it could be an Instagram message, it could be an email, it could be a phone call, whatever feels authentic for that relationship. We're reaching out to them, and we're not asking them, hey, do you want to invest in me? What we're doing is we are asking them, what is your appetite for investments at the moment? And so I encourage you, if you want to take action immediately following this video, just send a message to the top 2 or 3 names that come to mind, and send them a message along the lines of this. Say, hey, whatever their name is, insert a personalized message so it doesn't look copied and paste. For example, just seeing you got back from Dubai recently, holiday looked amazing, hope you and the kids had a good time. Then you want to say, I'm getting into property, or I'm looking at some great property deals, or I'm working on some exciting projects in the property market at the moment. Saw your name in my phone, thought I'd reach out and ask, what is your appetite for investments at the moment? Either way, it would be good to catch up soon. Kind regards, Tyler. Whatever. Structure it and change it. But to break that down, the first thing you want to do is, of course, personalize it so it doesn't just look like a generic copied and pasted message. It sounds authentic. The second thing is you want to say that I am looking at some property deals, or I am getting into property. The point I'm trying to make is you want to sound like you are doing it. It's this with or without you energy. There's no sense of desperation. It's like, oh, I would love to get into property this year, but I just need an investor. Would you be willing to invest in me? You don't want to sound like that. When you can showcase to someone that, like, I am doing this one way or another, it's up to you if you want to join me on this journey. There's something very compelling about that. And then the third thing to really break that message down is you're asking them, what is your appetite for investments? You're not asking them, do you want to invest in me? Do you want to look at a project together? It's just, what is your appetite for investments? And ultimately, what we're hoping for is a positive response where they say, it's funny you said that, I'm open to a conversation. And that's it. Now, there are going to be some people that say, thanks for the message, great to hear from you, not interested at the minute just because my money's tied up in other things. And that no doesn't mean no forever. It just means no for now. It means no until they're ready. It means no until they've watched you on social media for the next 6 months, 12 months, 2 years doing it. And then they're going to be further down the line. Hey, Tyler, you reached out to me 12 months ago. At the time, I wasn't ready, but I've seen what you've done on social media. I've seen a couple of deals you've done. Looks really impressive. Would love to have a conversation, see what we can do together for the next one. And so when someone says no, don't take it personally. It doesn't mean no forever. It just means no for now. Put them into the pipeline, nurture them. And so that's step one, personal professional network. I'm going to go through the remaining 3 and then I'm going to explain to you what we do once we've kind of got this initial connection, this initial contact made. So step number 2 is we want to get in the right rooms. Now, this could be going to property networking events where you can find investors. But the problem with some property networking events is 99% of the people in the room are looking for money, 1% of the room have money. And so if you back yourself as being one of the top 1% operators in the room, one of the best presented people that can, really win that person over, great. You will find opportunity at these events. I think there is a time and place for property networking events, especially for finding your professional team, finding local architects that have specialized knowledge, finding maybe your commercial finance broker, maybe finding a good lawyer, maybe finding a good project manager, or just connecting with other people that have the success that you want to have in that area and building relationships with them so you can learn from them as well. But you can also attend business networking events where you're going to connect with other business owners, and you just want to get in the right rooms. You just want to get around people, whether that means joining friends for a dinner where you're going to meet maybe some of their associates. And yes, the bill might come and it might be a little bit more than what you're used to spending on dinner, but if you're there and you work with the relationships and build contacts, you need to understand that there's a return on investment with that. For me personally, I've said it multiple times, I intentionally joined the most expensive gym that I could find in London. It costs upwards, I think, £7,000 or £8,000 per year. And it's a beautiful gym, but the bench press is no different to the Pure Gym bench press down the road, which is £19 per month. But when I was making the decision to join, I thought 2 things. One, I'm never going to be frugal when it comes to my health, because I know if I lost my health today, I would trade every asset I own to get it back. And so if by joining this gym, I feel more compelled, more excited to go and care for myself, that's an investment I'll make every day of the week. But the second reason is I just knew the caliber of people that are also going to be attending that gym. These are the people I want to build connections with. And lo and behold, I've made unbelievable connections. I've connected with some family members of some of the richest people in various different countries around Europe and the world. I've connected with people that have sold companies for 9-figure amounts. I've raised money from people I've met in the sauna. I'd sit with somebody in the sauna. I'm there. I'm starting a conversation with someone. I want to get to know, what's your name? Who are you? And it's not in an inauthentic way. I'm genuinely interested. I'm genuinely curious. I want to make friendships. And not everyone is going to be an opportunity. But I understand there's ways that raising finance it's a 2-way street. There's a fair exchange of value. And this is probably the third mindset shift that I should have touched on. We grow up in an environment where when you're young, when you're asking for money, whether it's from family members or friends, you're typically asking for a favor. And it feels a little bit one-sided. Like if someone is giving you money, they're doing you a favor. But when you're raising finance for good opportunities, you are providing an opportunity to them as well. It's a win-win. And so when you are raising finance and building these relationships, it's not you trying to extract things and take things from people. There's a fair exchange. There's a give and a take. And so pay whatever price you can to get in the rooms with extraordinary people. If you haven't joined the most expensive gym in your area, it's like one of the simplest, most high ROI things you can do if you're prepared to make connections, if you're prepared to hang out there, maybe work out without your headphones, so you're more kind of likely to start a conversation with someone you look more approachable. Just make a commitment. I'm going to introduce myself to one person every workout. I'm just going to say hi to someone, because one thing I've realized in the gym, especially without going on a tangent, is it just starts with like a head nod. You just head nod to someone that you've seen a couple of times, and then the next time you see them, it's like, oh, hey, and then the next time you see them after that, it's like, oh, like, how's it going, mate? And then before you know it, the 4th, 5th, 6th times, it's like, what's your name, by the way? Like, obviously see you here every day. Like, I'm Tyler. What's your name? And then boom, you go have a coffee with them, agree to have a coffee, and that relationship has started. So you're not cold approaching people saying, hey, how are you? My name's Tyler, I'm a property investor, I'm looking to raise finance. No, it's genuine, authentic connections and relationships we're trying to build. The third thing, or the third way, the third step is through LinkedIn. LinkedIn is an unbelievable platform for connecting with potential investors for a number of reasons. One, you can target people based on their job title. So if they're a managing director, if they're a doctor, they're a lawyer, they're a financial director, CEO, CFO, whatever, you can connect with all of these people. And secondly, you can connect with those people that are in your area. And so you can connect with them and reach out to them and do the outreach. And there's a very specific script that we provide where you can book in meetings with these people. But at the same time, even if they don't reply to your messages straight away, if they're not interested straight away, by connecting with them and them accepting your connection request, they're then going to see all the content that you produce that is going to be valuable. And at some point in the future, if it's a no now, well, that might turn into a yes in 6 months, in 12 months. Because the hardest money you're ever going to raise is the first money you're ever going to raise. The hardest deal you're ever going to do in property is likely the first deal you're ever going to do. And so when you're going through the process of starting this journey of raising finance, it's always going to be hardest at the start, but it's hard until it isn't. Because you do one deal, people see it, they witness it. You are sending them updates every month, nurturing them. It's like, hey, just completed on this acquisition. I know we spoke about some property stuff a couple months ago. Thought you'd be interested to just know I've secured some funding and this is a deal that I'm doing. Here's the numbers. And then a month later or 2 months later, you check in, it's like, deal's going well, actually think we might be able to achieve more than what we initially expected. Cool. And then you nurture those relationships. You do that first deal, there's going to be a couple more people that are interested. You do your second deal, your third deal, your fourth deal. Before you know it, you've built a reputation. You've nurtured these contacts for 1, 2, 3, 5 years. And that's why you see the wealth and the progress of not just the richest men in the world, but people that have been in the property game for 5, 10 years. It's an exponential curve. So that's number 3, LinkedIn. Number 4 is building your brand, which I've just referred to. And your brand is what people know about you, and that's primarily through utilizing social media, documenting your journey, using social media as a tool to build relationships at scale. Your personal brand is your digital reputation. It's what people know about you. And when you create content, you're basically duplicating yourself, and you're having assets that work for you 24/7. When I refer to assets, I'm referring to digital assets. Videos where you're showcasing projects you've worked on, you're demonstrating your knowledge, you're demonstrating and spotlighting the team and the experience of the team that you have through all this content that you've created. And those videos work for you 24/7, and they're infinitely scalable, where people can view something 1,000 times, or can view it 10,000 times. And people, again, are pleasantly surprised with actually how much impact you can have with a relatively small but engaged audience. You don't need tens of thousands. You don't even need multiple thousands. You need hundreds or a couple thousand of engaged people, the right people. And put out a video, and I saw someone recently, they said to me, I told them my videos are only getting 1,000 views. I said, well, type into Google Images and search how much is 1,000 people, and we'll put it on the screen. 1,000 people is a lot of people. Somebody said they had a post on LinkedIn which got seen by 50,000 people. I pulled up an image and showed them what 50,000 people looked like. If you think Wembley is 90,000 people, well, if you have a video that gets 90,000 views, that's a lot of eyeballs to be getting in front of. And so you really don't need to be getting tens of thousands of views. You just need to be seen and engaged with the right audience. So I'm going to do a separate video on kind of personal branding and content creation. But there are the 4 main ways that you can make the initial connection with an investor. So how do you progress that conversation? Let's go back to the example of step 1, where you're tapping into your personal professional network. And the one thing I didn't mention about your personal professional network is there are going to be some people you should reach out to that might not necessarily have money themselves, but they've got a valuable network themselves. So that could be actually people that are accountants or lawyers or doctors, or maybe they're a personal trainer and actually the profile of clients that they train are going to be pretty well off people. These are people you can reach out to, where you just adjust the script a little bit and say, instead of asking what appetite do you have for investments this year, it's who do you know that might have an appetite for investments? Would love an introduction. And so let's say you send that message out, you have a positive response. The mistake you never want to make is when you start this journey of this initial contact point with a private investor, is they might start asking questions like, yeah, what's the deal? What's the return? What's the ROI? How does it work? And I see people fall into the trap of starting to answer all of these questions and immediately you're on the back foot. Ultimately, what you want to do is you want to get a meeting booked. I call it a discovery meeting. It could be a Zoom call, Google Meet, or Microsoft Teams, or it could be a coffee, it could be going out for dinner, it could be playing them a game of paddle or a round of golf. But you want to be able to actually have an opportunity where you can discuss at length with them. And I personally do a lot of them on Zoom. Some I'll do kind of in person if it makes sense for my calendar and depending on where they're based in the country. But this discovery meeting, that's what you're trying to sell. And so if you get a positive response, or you meet somebody in the sauna, or reply to a WhatsApp message, or they message you on Instagram, you say, look, best thing to do is let's just jump on a call or have a coffee and I'll explain with you how everything works. And there might be a little bit of qualification you want to do if you're not too sure who they are. But if you're confident there's someone that has a bit of money, just go straight for the meeting. And this discovery meeting, it's a sales meeting, because raising finance is sales. You're selling an opportunity. You're selling yourself. You're selling the deal. You're selling your team, and all of those three things make up the opportunity. And so, again, without going down the whole rabbit hole of explaining the entire sales process and how to sell, really, the first thing you want to do is set the agenda of the meeting and say, look, how I like to do these meetings or how I like to do these calls is I'm going to ask a few questions to better understand kind of where you're at. From that, we can obviously talk a little bit about what I'm up to, the type of deals that I'm doing, and we can just decide if there's a good fit, and we can figure out together, do we want to explore this conversation further? And really sets a nice tone. And the first then part of that call is really the discovery phase. So in any sales call, sales meeting, whatever, sales environment, you almost have to act like a doctor, because you can't just diagnose someone and prescribe something without first asking a load of questions to fully understand their situation. And the reason this is important is to loop it back to the first topic we spoke about, which is the different creative financing structures. Because different investors are going to be better suited for different things based on the level of capital they have, based on their risk tolerance, etc., which we'll come on to. So this discovery phase is where you're just asking the investor questions. And I like to break it down into, there's three things you're trying to figure out. And so with this meeting with the investor, the first thing is you're trying to figure out what is their level of awareness. And the level of awareness is just a fancy word for what is their level of sophistication, how educated are they? Because you might have a conversation with someone where they are a lower level of awareness, they're less sophisticated, as in they've just inherited £200,000, but they've never made an investment before, maybe even never bought a property before, they don't know how a mortgage works. Well, that means you're going to have to take a much more educational approach to this conversation. If they're high level of awareness, as in they're a successful business owner, they've funded many property entrepreneurs before, they've lent money or they've invested money in other people's deals, well then that conversation is now going to be more facts, figures, evidence to support your numbers, risk mitigation, etc. So that's the first thing, level of awareness. The second thing you want to figure out is what is their level of intent. And so level of intent is essentially how motivated are they? Are they someone that's saying, I've got £100,000 burning a hole in my pocket, like I want to put it to work in the next 30 days? Or is it someone that says, yeah, I've got a lot on my plate right now. If there's an amazing opportunity, sure, but probably not for the next 6 to 12 months. Again, that's going to then determine what level of urgency you apply to this conversation. And then the third thing we need to understand is what I call qualification. So how much capital are they looking to play with in the short term? And even I want to understand, is there a long-term relationship to be built here? It's what is the type of returns and the level of returns they might be expecting. So there's a number of questions you can ask around that. Again, you want to be asking open questions, not closed questions. So we provide to a lot of our clients a full list of questions that you want to be asking. And so that could be asking things like your current investments. Is there a level of return they're achieving, which is going to act as the benchmark that we also need to be targeting should we work together, kind of thing. Or is there a level of return that would get you excited about a particular opportunity, et cetera, et cetera. And so that's level of kind of qualification. And also what's their risk tolerance, and have they got a preferred method of doing things? Because again, if they're a sophisticated investor, they might be telling you, look, I only want to do first charge lending. I personally have an investor I know that I know very well, and he says, I will lend you as much money as you want, as much money as you need, but it's got to be on a first charge, and I'll only lend up to 80% of the purchase price. It's like, fine. And so that now allows me to understand, okay, should an opportunity pop up where that would work, I know he's someone that I can go to. And so once you've kind of navigated this discovery phase of the sales meeting, there's, of course, the opportunity then for you to present yourself. And I personally don't believe at this point you need like a crazy pitch deck. It doesn't need to be too formal. You just want to give them a high-level overview of who you are, who your team is, and the type of projects that you're going to be doing, what your business plan is, and what it could look like if you were to work together. The important thing to kind of answer here is, I know a lot of people listening to this are going to be thinking, well, I have no experience. How do I raise private finance if I have no experience? Well, there's two answers to that. Primarily when I tackle this conversation with someone one-on-one, the first thing I kind of establish is that just because you've never done a property deal before doesn't mean you don't have any credibility. And so I was recently speaking to a young individual that was ex-military, was currently in the military, and he's just leaving the military as we speak. Now, he's never done a property deal before, but after kind of probing and asking a few pressing questions, eventually I understood, kind of very high level, there's a lot more to it, that he was responsible for leading teams of close to 20 people. He was responsible for certain task force missions where they took days and days and days of preparation, where they were extracting high value assets out of war zones. He was responsible for managing millions of pounds worth of military assets. And by working in the military, we also know that we can make some assumptions. He's probably got very good attention to detail, very good at planning, very high standards, very disciplined, etc. And so by kind of building that story, building that narrative, suddenly demonstrating a lot of credibility. Where I know if someone can lead a team of 18 people and within the military has been responsible for these incredible missions which require so much planning, I'd like to think he'd probably be able to figure his way through a simple refurbishment on a property. And my experience is most people, the majority of people, have credibility. They're just sometimes too humble to actually figure out what that is and actually back themselves and think, actually, I have achieved this, I have done that. And maybe that's some imposter syndrome, but oftentimes it's enough if it's positioned in the right way to present yourself in the best possible light. So we call this positioning. How are we positioning you? How are we packaging you? The second thing is the team. So you might have never done a property deal before, but ultimately when an investor is making a decision is, do I want to be part of this opportunity? The opportunity is, yes, the deal and the numbers, but it's also who's the team that's delivering it. Because if you've never done a deal before and you're going to be telling the investor, oh, I'm going to be the one that's kind of doing all of the project management and I'm going to be doing a lot of the works myself. Well, for some investors, that might be, okay, that's an element of risk there I'm not too comfortable with. But if you've built a team where you can say, this is my project manager, and this project manager has done 12 HMOs over the last 4 years in this area. This is what he does. This is who he is. These are the deals he's done. He's solid. This is the architect that I'm going to be employing. He's an award-winning architect. He's specialized in this area for the last 10 years. He's won this award, and his success rate at getting planning applications through is pretty high. And stuff like this is bread and butter, what he does every day. This is my commercial finance broker. This is my legal team that's going to be advising me. This is the contractor that we're going to be using for this, etc. So if you look at any pitch deck of any big company that's ever raised money, even outside of the property world, one of the first couple of pages is always about who's the team, because investors want to know who is the team. And your job as a property entrepreneur, as a property business owner, is to find the deal, find the money, and assemble the team that's going to help deliver the project. And when you're pitching to an investor, if you've got a deal and you've got a good team, really, there's not much more for you to do beyond that point other than just make sure everything kind of runs smoothly and a bit of quality control and solving problems along the way. Now, you want to be having these conversations with an investor even if you don't have a deal yet, because the result, the outcome that we're trying to achieve when we are having this conversation with an investor is not necessarily, hey, great to chat with you, here's the deal, do you want to fund it? In my opinion, you want to be getting some kind of soft commitment. And that soft commitment is either them saying, Tyler, I've enjoyed this conversation. I'm impressed with the team that you've built. I like the kind of deals that you want to do. I've got 200,000, 100,000, 50,000, £500,000 that I'd be looking to play with if you were to present me the right opportunity. So it's a soft commitment in the sense they're not saying, yep, send the bank details, send the contracts, I'm happy to wire 200 grand into your account. They're kind of saying, subject to you bringing the right opportunity, I'm happy to explore this conversation further, and I've potentially got X amount of money that I'd be willing to kind of fund. And again, depending on where they're at, if they're someone that wants to move quick, they're ready to mobilize funds, or they're well capitalized and they're willing to kind of deploy funds pretty soon. But then that next conversation, you can agree that, well, look, I'd love to explore this further with you. How about this? How about we catch up soon? I'm looking at a couple of deals at the minute. I'm towards the latter stages of negotiations. Once I've got a bit of clarity on that, I'd love to present the opportunity to you, and you can decide if we can work together, or we can decide together if we're going to work together. And a lot of time they're saying, it's fair enough. Because one of the best metaphors for raising private finance is like trying to find a girlfriend. And so this one is for the guys, but I'm sure any females listening to this will probably understand. Some people attack raising finance the equivalent as going up to a girl on the street or a girl in the club and telling her, do you want to have sex with me tonight? And for the most part, for most guys, your success rate doing that isn't going to be great. Now, maybe if you ask enough, but even then, it's not really a good strategy. And so if you want to have a girlfriend or build a relationship with a female, there's a nurturing process. You start with the coffee, or you start with the dinner. You start with just giving them an insight into kind of who you are and understanding who they are. And at the end of the first date, at the end of the first coffee, you decide together if this is something you want to explore further and do it again. And then beyond that, eventually you seal the deal. And it's the same with investors. It's a sales process where you're nurturing the investment, you're establishing rapport, you're establishing a good fit, you're understanding kind of who they are, their risk profile, their preferred way of doing things, what level of capital they have to play with. And then when you've got an opportunity, you present them that opportunity. And the opportunity at that meeting, when you have the right deal, it's what are the numbers, providing compelling evidence to substantiate those numbers, being able to analyze all of the different risks in the deal, from the construction risk, the financing risk, the exit risk, the planning risk, the execution risk, being able to describe all of the different ways you're mitigating that risk. Who is the team that's involved? And what are the financial metrics? What is the projected returns, or what is the way it's going to be funded? So that is an end-to-end walkthrough of raising private finance. If this is something you'd like help with and something you'd like to learn more about, I strongly encourage you to check the first link in the description. where I explain exactly how you can start this process in the next 90 days. Appreciate your time and attention, and I'll see you guys on the next one.